Welcome to Global Plot Economy, where we decode the hidden financial mechanisms that silently shape our world and determine your wealth. In February 2026, the silver market witnessed a catastrophic collapse that wiped out fortunes in mere hours of trading. Investors watched in horror as their positions evaporated, leaving them confused about the true cause of this sudden financial disaster. To understand this crash, we must look at the decisions made by the CME Group in the weeks preceding the event. A series of critical changes occurred between December 2025 and late January, setting the stage for a perfect storm. The exchange increased silver margin requirements 8 separate times within just an 8-week window, an unprecedented rate of aggressive tightening. These aggressive hikes were designed to squeeze liquidity out of the market, forcing traders to come up with more cash immediately. This was not a local event, but a global signal that the rules of the game were being fundamentally rewritten. The timing of these margin hikes was particularly suspicious, occurring during the holiday season when the banking systems are typically very slow. They chose moments like Christmas and New Year's Eve to implement changes, knowing full well that liquidity would be extremely thin. Investors found themselves unable to transfer funds or contact brokers effectively because the banking sector was effectively closed for holidays. Receiving a margin call during a bank holiday is a nightmare scenario for any trader, regardless of their portfolio size. While the world celebrated the festive season, the silver market was being quietly rigged for a massive correction in February. The sequence of events was like a row of dominoes carefully set up to fall exactly when the market opened. The most significant structural change occurred on January 13th, a date that would seal the fate of many retail investors. On this day, the CME Group switched from a fixed dollar margin requirement to a dynamic percentage-based calculation method. This shift created a sophisticated trap where rising prices would automatically trigger higher capital requirements for anyone holding a position. As the price of silver climbed higher, the cost to maintain that position increased proportionally, squeezing traders even when profitable. Traders faced a paradox where they were making money on paper, but were forced to deposit more cash to stay in. This dynamic margin system acts like rising water, eventually drowning those who do not have unlimited reserves of fresh capital. This structure highlights the massive asymmetry between small retail investors and the gigantic institutional whales that dominate the global market. Large institutions have deep credit lines and likely knew about these policy changes well in advance of the public announcement. Meanwhile, the individual investor is left in the dark, reacting to news only after the traps have already been sprung. The result is a systematic transfer of wealth from weak hands to strong hands through the mechanism of forced liquidation. When traders cannot meet the new margin requirements, their positions are forcibly sold at market price, driving prices down further. This selling pressure creates a feedback loop where falling prices trigger more margin calls, causing even more selling and panic. In the midst of this chaos, it becomes impossible for the average participant to see the true direction of the market. While Western markets collapsed, a strange anomaly was occurring across the ocean in the physical silver markets of Shanghai, China. Despite the crash in futures, the premium for physical silver in Shanghai skyrocketed to $40 or $50 per ounce. This massive divergence suggests a disconnect between the paper derivatives market and the actual supply and demand for physical metal. Some analysts argue this premium was due to logistics barriers preventing arbitrage rather than simple manipulation of the global price. Capital controls in China also play a significant role, making it difficult for money to flow freely between these markets. However, to truly understand this event, we must look back at history, as these patterns have repeated multiple times before. Similar cycles of margin hikes and market crashes occurred famously in 1980, wiping out the Hunt brothers' silver empire. We saw the exact same playbook used in 2011 to crush the silver rally and protect short sellers. This suggests that these crashes are not accidental bugs in the system, but rather intentional features designed to control leverage. Investors must realize that the derivatives market is designed to shed risk, often at the expense of the over-leveraged speculator. The system is built to protect the house, ensuring that the central clearing parties never fail, even if traders do. Retail traders are often the pawns sacrificed to maintain the stability and solvency of the larger financial infrastructure and institutions. Every few years, a new generation of investors learns this painful lesson, reading about it only after their capital is gone. Thank you for watching Global Plot Economy. Subscribe now to understand the hidden forces moving markets before they move you. Let us dig deeper into how interest rates provided the perfect cover for these margin changes to go largely unnoticed. The Federal Reserve's monetary policy created an environment of uncertainty which the exchange used to justify their aggressive margin hikes. Liquidity was already drying up before the crash, making the market incredibly fragile and susceptible to sudden violent price swings. High-frequency trading algorithms exacerbated the move, detecting the weakness and selling instantly faster than any human could react. The market tension had reached a breaking point, and the margin changes were simply the final cut that snapped the rope. When everyone tries to exit a leveraged position at the same time, the door is simply too small for everyone. This event serves as a stark warning about the dangers of holding excessive leverage during periods of high structural uncertainty. Those who held physical silver without leverage slept soundly while paper speculators faced sleepless nights and total financial ruin. The contagion spread beyond silver, affecting gold and other commodities as traders sold everything to cover their margin calls. It is hard to believe such precise timing was coincidental. It bears all the hallmarks of a coordinated market operation. Most investors never read the fine print where the exchange reserves the right to change margin requirements at any time. In the modern financial era, liquidity is a privilege, not a right, and it can be revoked without warning. The dark clouds over Wall Street in February 2026 will be remembered as a classic example of a liquidity trap. The playing field is not level. Institutions play by a set of rules that allow them to survive these shocks. For the retail trader, the game often ends with an empty account and a hard lesson about market mechanics. The futures market is a digital abstraction, often completely detached from the physical reality of supply and demand fundamentals. Witnessing such a rapid collapse challenges our belief in free markets and exposes the control exerted by centralized exchanges. Navigating these markets is like sailing a small boat in a hurricane. Skill matters less than the severity of the storm. Knowledge of these structural risks is the only key that can unlock safety and preservation of wealth in such volatile times. As the sell orders flooded the system, the bid side of the market completely evaporated, leaving prices in free fall. Circuit breakers were triggered multiple times, pausing trading briefly, but the selling resumed immediately once the markets reopened. Behind every chart and every statistic are real human stories of devastation, lost savings, and shattered financial dreams. The shockwaves traveled around the earth, affecting markets in London, Tokyo, and Hong Kong within minutes of the U.S. Open. While gold also suffered, silver's smaller market cap made it significantly more volatile and vulnerable to this type of manipulation. Predatory algorithms hunted for stop-loss orders, pushing the price down just enough to trigger them before reversing course. The margin hikes acted as an impenetrable ceiling, ensuring that the price of silver could not break out significantly. Paper wealth can be destroyed in an instant, reminding us why physical assets have served as insurance for centuries. The precision of the timing suggests that this was not a random accident, but a carefully engineered financial event. Traders who were overextended found themselves falling into the abyss with no safety ropes to catch them this time. By the time the damage was visible, it was too late for any emergency measures to save the affected portfolios. Diversification offered little protection as the liquidity crunch caused correlations between all asset classes to approach 1. The automated nature of these margin calls meant there was no human broker to negotiate with, only cold execution. For many, the hope of recovering their losses faded quickly as they realized the permanent nature of the market shift. These towering institutions are designed to survive centuries, while individual traders are often just temporary visitors in the market. While central banks printed money to save banks, no such lifeline was extended to the individual futures traders. Markets eventually recover, but the capital lost by the individuals during the crash is gone forever, never to return. The reality of an overdrawn account is a harsh wake-up call for those who believed trading was an easy path. Trading on margin is a high-wire act. One gust of wind from the exchange is enough to cause a fall. The long wicks on the daily candles show the extreme battle that took place between buyers and forced sellers. Ultimately, the wealth was not destroyed, but simply transferred into the vaults of those who set the rules. The checkmate was delivered swiftly and efficiently, leaving the retail side with no legal recourse or way to recover. You cannot fight the current of the market when the dam breaks. You can only hope you are on high ground. Constant vigilance is the price of admission in a market structure that is inherently designed to hunt for your weaknesses. Traditional indicators failed to predict this move because it was driven by structural changes, not by market sentiment. Understanding the rulebook of the exchange is far more important than understanding technical analysis or reading chart patterns. Only after the dust settled did the true picture emerge, revealing the calculated nature of the entire operation. The market spent months licking its wounds with volatility, remaining high as confidence in the system was slowly rebuilt. Survivors of the crash had to start from scratch, planting new seeds of capital with much more caution than before. We must take a step back and view these events through a long-term lens to see the cyclical patterns. Just like the phases of the moon, financial markets move in cycles of expansion and contraction, greed and fear. The pendulum always swings back, but it often swings too far in one direction before correcting itself violently. The global economy is a machine that requires occasional resetting, and margin crashes are the reset button. Out of this chaos comes a new order, with wealth concentrated in fewer hands and the market ready for a new cycle. From the vantage point of history, we can see that this was not a unique event, but a recurring theme. Since the crash of 29, leverage has always been the double-edged sword that cuts both ways for investors. Risk management is your only shield against the arrows of market manipulation and sudden structural changes. Technical indicators are useless when the fundamental rules of the exchange are changed overnight by the governing body. Emotional control is essential. Panic is the tool that institutions use to force you out of your positions. Holding physical assets removes you from the casino of the futures market and places you in the real world. The futures market often resembles a casino where the house sets the odds and can change them at will. Sometimes the only way to win is to unplug from the system and refuse to play their rigged game. Fighting the trend created by institutional margin hikes is a futile effort that will only lead to exhaustion. Cash flow is the lifeblood of any trader. When margin hikes cut that flow, the trading business dies instantly. Even large positions and experienced traders were uprooted by this storm, proving that no one is truly safe. As we piece together the evidence, the picture of a coordinated effort to suppress silver prices becomes undeniable. Decisions made behind closed doors in Chicago had devastating consequences for families and investors all around the world. A simple signature on a policy document carries more weight than millions of dollars of buy orders in the market. The scales of financial justice are heavily tipped in favor of the exchange and the large bullion banks. We must learn to spot these warning signs from a distance long before the margin calls actually arrive. Volatility is the weapon used to shake out weak hands, and margin hikes are the trigger that fires it. Paper profits are like sandcastles. They look impressive until the tide of margin requirements comes in to wash them away. Real money has no counterparty risk, a lesson that silver investors relearned the hard way in 2026. In the information age, news travels fast, but the structural changes often happen faster than the news can report. For those caught in the trap, it became a desperate race against time to liquidate assets and find cash. The warning lights were flashing for weeks, but greed blinded many to the reality of the impending crash. Understanding these cycles allows prudent investors to step aside or even profit when the inevitable crash occurs. While paper prices crashed, the difficulty of mining and refining actual silver remained exactly the same. The physical reality of silver cannot be printed or manipulated in the long run, unlike the paper contracts. The illusion of wealth created by easy money evaporated, leaving only the hard truth of solvency and collateral. Assets were sold at fire sale prices, providing a massive buying opportunity for those who had kept their powder dry. Smart money swooped in like a hawk to pick up valuable assets for pennies on the dollar. Rebuilding trust and capital takes time, patience, and a commitment to never ignoring the structural risks again. Despite the crash, the long-term secular trend for silver remains intact, driven by industrial demand and monetary debasement. Industrial demand for silver in solar panels and electronics continues to grow regardless of the games played on the COMEX. Technology cannot function without silver, ensuring that the physical metal will always have intrinsic value and demand. The green energy revolution guarantees a floor for silver prices, even if paper markets try to suppress it. The structural deficit in silver supply is a reality that paper derivatives can obscure but cannot change forever. As stockpiles drain, the leverage of the paper market becomes weaker and the potential for a squeeze increases. The suppression of price acts like a pressure cooker. Eventually, the lid will blow off with explosive force. The next rally will be powerful, and only those who understand the rules of the game will ride it successfully. Documenting these events is crucial, so that we do not forget the tactics used against us in the future. History is our best teacher, and the lessons from February 2026 are now part of the curriculum. Global plot economy aims to be your lighthouse, guiding you through the treacherous waters of the global financial markets. We must band together as a community of informed investors to protect our interests against institutional predation. Sharing this information is vital to waking up others to the reality of how the system is rigged. Financial literacy is the seed from which true wealth grows, and understanding margin risk is the root system. The sun will rise again on the silver market, and those who are prepared will be ready to seize the day. Gold and silver remain the ultimate store of value, surviving every currency collapse and market crash in history. Secure your wealth by owning assets that do not rely on the promises of a bankrupt financial system. Looking at the timeline, we see the echoes of 1980, 2008, and 2011. These are not random events, but repeating verses in the same song of leverage, greed, and inevitable liquidation. Take a moment to reflect on your own portfolio and ask yourself if you are exposed to these hidden risks. Eliminating margin debt is the single most effective step you can take to immunize yourself against these crashes. Remember, the crash is not a bug in the system. It is a feature designed to flush out leverage. You must be the captain of your own ship, steering clear of the rocky shoals of the futures exchange. There is peace in knowing that your wealth is safe, regardless of what the CME Group decides to do. Remember the 8 hikes, the holiday timing, the rule changes, and the Shanghai premium as you plan ahead. We hope this analysis has provided you with the clarity needed to navigate the treacherous waters ahead. Thank you for watching Global Plot Economy. Subscribe now to understand the hidden forces moving markets before they move you.